Funding without banks' traditional bank loans are getting slower, stricter, and harder to secure, especially for startups and small businesses. What if you could get capital based on your revenue performance and data signals, not just your credit score? In 2026, businesses are turning to a new era of funding that doesn't rely on traditional banks. Let's get real, money fuels growth. But for many businesses, the biggest challenge isn't the idea. It's getting the funding fast enough to scale. Banks still matter, but they're no longer the first option for many founders and CFOs. Here's why. 1. Revenue-based finance. RBF instead of fixed monthly debt payments. RBF lets you borrow money and repay it as a percentage of your revenue. When sales are strong, you pay more. When sales dip, you pay less. This aligns incentives between you and your funder and makes cash flow easier to manage. Many fintech platforms now automate this, so companies can secure RBF deals much faster than traditional loans. 2. Instant microlending for business needs. Today's fintech solutions offer near-instant lending decisions, sometimes in minutes, based on your real revenue, transaction history, and business performance data. No lengthy bank paperwork. No endless credit reviews. This is especially useful for short-term working capital, inventory boosts, or marketing campaigns that need immediate funding. 3. Alternative credit scoring. Your credit score used to be the key to funding. Now, lenders are using data signals, like payment history on invoices, platform sales performance, digital transaction volume, and even social reputation to determine creditworthiness. This opens the door for companies that were previously sidelined by strict credit rules. 4. SaaS plus fintech funding integrations. Software platforms now embed funding offers directly inside your tools, whether it's accounting software, e-commerce platforms, or payroll systems. So when you're reviewing your books, you might see pre-qualified funding options tailored to your actual performance. No separate process, no separate app. So what's the practical takeaway? If you run a business today, the landscape of capital access has changed. You don't have to wait months for a bank decision. You don't have to fit a rigid credit model. You can access funding based on your company's performance data. This speeds up growth and levels the playing field for smaller companies, especially in markets where traditional banking is slow or constrained. Many founders say the biggest competitive advantage today isn't the idea. It's access to the right capital at the right time. And these new funding mechanisms deliver exactly that. So here's the bottom line. You no longer need to spend months chasing bank approvals. You no longer need to beg for financing. In 2026, funding is faster, smarter, and performance-based. Business growth happens when money flows as fast as ambition.